Welcome to Real Insights. Today we're talking with Patrick Scanlon, Senior Director of Market Analytics at Costar Analytics.
Hi Patrick, welcome to the Real Insights podcast.
Thank you very much. I'm really glad to be here.
So Patrick, you are the Senior Director of Analytics at Costar, which I believe is the largest real estate data platform in the world. So maybe you could tell us a bit about your background and your role at Costar.
Yeah, of course. So I kind of in a way stumbled into real estate analytics like a lot of my peers. There's very few of us that actually left school wanting to be a real estate data analyst, to be honest. But I had a background in statistical analysis, more on the sort of social side. And I went traveling around New Zealand back in 1999 and came back and was looking for work and ended up getting a job at JLL in their West End agency team, where I was basically just inputting data, making sure their database was running properly, that kind of thing. Did that for 5 years, then popped out to KF, where I spent 13 years as I ended up being their head of Central London offices research. And the background in the data inputting, the data management, the data analysis from JLL really carried through to help me understand the market a lot more. I think you become a lot stronger an analyst if you've actually had to get your hands dirty with the data. Makes a massive difference. There I had another couple of positions. I went to Cushman & Wakefield, where I was head of UK offices research. Avison Young with a similar position. And then in February this year, I joined Costar, which was something that I'd always kind of, I think dreamt is probably a strong word, but I'd always had on my radar for a long, long time, ever since the days when Costar was Focus, probably like 10, 15 years ago. And the reason being that doing what I do, you want to do it with the best data you possibly can. And, although the data offering at a lot of the UK agencies is good, Costar has invested tens and tens of millions of dollars in collating data, building a platform that can display that data correctly, and more importantly, making that data available through the analytics platform so that customers can actually chop it up however they want. So the idea that I could then go into Costar and have free reign all over this data to then represent it back to clients was massively compelling. What I didn't realize at the time is that at Costar, we do all of our analytics through the front end of the product, which is available to all of our clients. So I could have actually been doing all of this for the previous 15 years of my career. But I cover a much larger geography. I cover more sectors. I have a bigger audience. I think I've ended up where I was always meant to be, which is great.
Yeah, excellent. I think a lot of people talk about commercial property or property in general as being an opaque asset class. I've heard that term used quite a lot. I think particularly it's relevant around the access to information. So there's a lot of sort of private transactions that are going on. A big part of the market is private. How do you sort of think about real estate compared to other asset classes and how that information is opaque, but also extremely valuable in terms of decision making?
Yeah, it's getting more and more complicated as the years go by. So now there is obviously a requirement to register any sales with Land Registry, which has opened up a massively accessible source of information for everybody now. Obviously, it costs a little bit to get hold of that, but it's well worth it in the long run. So on the investment side, you can normally get hold of the owner, and you can more often not get hold of the sale price, which is great. What's more tricky is the yield. You also have many a situation where the buyer is a vehicle for the real owner, so you don't actually know where the money's coming from the Land Registry. And so things like that, that's where you have to then get involved, get on the phones, and start ringing around. The fact is that there is, the UK, for example, and the US are very, very different in terms of the way they treat data. So in the US, what will tend to happen is a broker will complete a deal, whether it's an investment deal or a leasing deal, and as soon as it's completed, he'll be on the phone to all of his friends, telling them, how big it was, who the tenant was, what the rent-free was, what the incentives were. they're really proud of the fact that they've done the deal. And as a result, the market is incredibly transparent in the US. You can get any information you want. In the UK, it's a lot different. I think we're a lot more cagey as a country.
Mm-hmm.
But also you have a scenario where the landlord wants to look like they've got a great deal out of it. The tenant doesn't want to look like they haven't got a good deal out of it. So you'll have a situation where you will have, as for an office, a 20-year lease, and the tenant will have paid £80 a foot. The landlord's going all over that. It's great, £80 a foot, £80 a foot. But the tenant says, I don't want you to say that to anybody because it looks like I'm being irresponsible, fiscally irresponsible. So I don't really want anybody to find out what I paid.
Mm-hmm.
The reality is that obviously in the market, that £80 a foot looks fantastic. The tenant, on the other hand, I remember back in 2011, 2012, just after the GFC, a very, very large bank took a massive chunk of space in the city. And the rent-free was something like 4.5 years, 5 years on a 15, 20-year lease. And that was NDA to the hilt. Nobody wanted that to come out because news like that changes markets.
Mm-hmm.
And is that right? Is that wrong? I suppose, when you think about it in a different way, there are some buildings that have loan covenants that have to get a certain headline rent, and that owner is in a very difficult position. So they have to get that off. They have to get it out of the way. Does it mean the market is in a bad position? No, probably not. And again, that's where the nuance comes in of understanding the data. Now, is that data available anywhere other than in the agents that represented both parties?
No.
Well, unless they tell anybody, no. And that's, again, where it starts to break down, because one agent will be in a wine bar and say, I heard that deal was £70 a foot. Are they talking about the blended rent? Are they talking about what the rent was on the best space? Is that net effective?
Yeah.
And that's where everything starts to get very, very messy. That's when methodology comes into play. So the one thing about Costar, which we're quite happy to rely on, is that everything is done to a set methodology. The researchers have a very strict bandwidth in which they can operate when they're on the phone.
Mm-hmm.
They search online sources, that kind of thing. But what we won't do is, you could tell me the details of a deal that you'd heard about. I could go back to Costar and tell them, and I probably would just for general info, but that will never make it onto the site,
right?
Because it's unverifiable.
Mm-hmm.
So I think the messier that the data world gets, the more we have to be really, really conscious that everything we are looking at has been sense checked and verified.
Yeah.
Because otherwise you get a scenario where rents are, for example, forever increasing because landlords just throwing in more and more incentives, such as options, rent freeze before and after the break, capital contributions.
Mm-hmm.
The fact is that a deal nowadays is never X square feet on X lease at Y rent. It's much more complicated.
Yeah.
So the way we would approach that is that nothing is ever 100% correct. We like to think we try and get as close as we possibly can, but sometimes that information just isn't available. So if you are, as you'll well know, if you're involved in actually bidding on a building, you'll know all that detail anyway. You won't need a third-party data provider to give you that.
Mm-hmm.
But what we want to do is help people through data and analytics to take a top-down approach and narrow down their buying or selling criteria or whatever to get to the smallest point they can, be that a geography, be that a subsector, be that a price point. And then within that, by using our data, they've got there, and then they can select their own options using their market knowledge and their experience and their expertise. So I think it's about data expectations, really. I think some people will expect data to be able to do everything for them, but it can never do that. And that's why we still exist as humans in an increasingly data-driven world. There's AI that can do all sorts of things. What it can't do is spot whether a particular building is at the right or the wrong end of a street in terms of its desirability.
Sure.
You take South Bank, for an example. I was doing some work on an asset in South Bank in a previous role, And we all know South Bank's great. It's got Borough Market.
Yep.
It's got views of the city. If you're in the city, you can't see the city, so it's actually quite a big deal. It's vibrant. It's really well connected. It's a funky place to be. But on all metrics, it comes up as an absolute dog's dinner as a location because of the river. And so if you look at amenity and transport and everything else in every other part of London, you look at like a 5-minute walk time around the asset.
A lot of it's river.
And you lose half of that because it's river. So if you were using data, you would never, ever buy anything in South Bank.
Yeah.
But we know that it's a good location. And how do we know that? Because, through our experience, through our day-to-day walking the area, chatting to people, relationships, that kind of thing.
Yeah, it's a really interesting point, and I'm going to plug Costar a little bit here for you. So when I visited Costar's offices in central London in the Shard, there's people that are sitting there who are on the phones all of the time, just speaking to agents and asking them about deals that have been done and plugging that into the database, I guess, through your systems and data checks and so on. But that to me was just really quite eye-opening, because I'd thought, well, that for one, I thought maybe that's a back office team, wouldn't be based in central London. And then I also sort of thought as data being something that just kind of exists in a computer system, and it's kind of automated and it just finds its way in there. But you actually have people on the phones, and from what I saw, quite a big team of people on the phones all of the time trying to find this information. And I think that's what I meant around property being an opaque asset class. There's no way to just set up a system that kind of absorbs all of the information. It taps into land registry, or it taps into whatever other systems or sources of information. It's a people-connected business, and you need to be speaking to people. Would you sort of agree with that?
Oh, 100%. And it goes beyond that as well. I mean, we have, I think, 130 researchers in the UK whose sole job is to basically gather that data. But so, we have API feeds, plug-in feeds for things like land registry, Glenagans, which is development data. There's basically every single third-party data provider you could imagine. We already have that coming into us as well, and that's then sense checked and sort of sorted. But what you don't see when you go to the Costar offices is, we've got a Glasgow office, Birmingham office, Manchester office, and in there are researchers, there are local researchers, salespeople. We have field researchers whose job, they're not office-based. They just basically spend their entire lives walking around cities or driving around to different locations, looking at tenant boards. Is our stacking information correct for that building? That tenant's not there anymore, so they feed that back to the research team who change it. Wow. They'll drive out to, they'll be looking at the Glenagans planning information, and they might say that this site has planning permission or is it demolished. They'll drive there and double check. They'll take a photo. The photo is on the website. So this isn't them using Google Street View. This is our people basically just going all the way around the country all day, every day, looking to make sure that information is correct. Has a building reached completion in central London? Mm-hmm. They'll go and have a look. On top of that, we've got drone technology. So if it's a site that we can't get into, they'll send the drones up, have a look around, see what's going on site. Maybe not in central London, it's a bit more, it's not very legal. But they'll take photos of it. We'll have a photo of the site, and they'll go back again 2 or 3 months later to double check it. So there is a big element of desk research and secondary research, but we've also got this sort of little army of people who just go around the country all the time, making sure everything's verified.
Yeah, incredible. So from that micro perspective, you're capturing the data in a really sort of granular way, and then I wanted to talk a little bit about how that granular data then moves up into these kind of large ways that we chop up the real estate world. So we can chop it up by geography, we can chop it up by sector, maybe quality of the building, or even risk profile. You've sort of got core plus, value add, opportunistic. So there's a number of ways that we can chop up the sort of commercial property landscape. I know when I was at my previous job as part of a global portfolio management team, I think I might have drawn the short straw there, in that I was tasked with trying to come up with global standards for how we divide up just even sectors. What is an office building? What is retail? What is residential? And then it changes over time because things that were alternative 10 years ago are no longer alternative now. They've kind of found their way into one of those traditional sectors. And I think people in general like stories. They like to hear that sort of office is underperforming, industrial is doing well. It's easy. It's kind of a nice, almost like a nice sound bite. But underneath that, there's so much going on. So I'm just wondering how you guys deal with the definitional issues in order to group things into the way that we like to group things.
Yeah. That's a great question. It's something that we're actually working on right now with retail. The US team has a slightly different set of terms to the UK and European teams, for retail parks, shopping centres, obviously they call them malls. A mall for us could be a sort of out of town thing, or that, for them they have strip malls, which are these tiny little kind of retail shopping centres on the side of the road that don't really exist here in any sort of organised way. So we are going through with them. We're having a bit of a fight, but we're getting close to a resolution where we can actually start looking at things globally because we've agreed on the definitions. I think that's one aspect of it, but the other aspect is, you're right. 20 years ago, it was easy. There were sort of objective sectors that everything pretty much fell into. With the rise of those alternatives and some of those alternatives becoming more mainstream, we're sort of wondering what we should do with them. And I think we've got there, but one thing you can't ignore is the importance of a data time series, right? So if we have, for example, office data time series or industrial data time series going back for 30, 40 years, what you don't want to do is start diluting that sector by taking things out of it. Because if something is still essentially an office, then, all of a sudden, it's kind of like the industry. There's one index, which I won't name on the pod, but a lot of landlords used to submit their data to, and then valuations would be done from it. And when private Middle Eastern overseas buyers started to come into the market 10, 15 years ago en masse, all of those properties were taken out of that index because there was no real incentive for those private buyers to keep submitting that valuation data. So it just got smaller and smaller and smaller and smaller. Now, still incredibly useful, but if you try and look at it in terms of a long-term history, I know they've done a lot of work to actually reweight it and make sure that it is accurate in terms of its weighting, but it's not a simple straight line analysis. And it just generates more work, especially for us if we have to start reweighting everything historically. So the way we get around that is, for example, for life sciences, which is a huge sector right now, that will come under sometimes offices, sometimes industrial, because the building might have been built for different purposes. But within our search functions, you can go to the amenities and you can search across all the sectors, but just look for bio and lab enabled space.
Oh, okay.
So that will actually kind of negate the need to search by sector because you're searching for the amenity.
Do you
instead.
let people sort of decide in a way, in their own way, how they want to build up their sort of top-down picture of the world and cut those up? That's really interesting.
Well, and interesting as well. The one of the things I hadn't necessarily realised about Costar's product before I got there is that you still get all of the analytics by doing that. So just by selecting that one amenity, you will get 20 years worth of take-up. You will get 20 years worth of vacancy data, absorption, months on the market. All of the stuff that you would associate with a normal sector, you can get just by selecting that one amenity. So everything that has that one amenity will go into that historic data feed, and then you can work your analytics off of that. So you can forecast from it. You can do anything really. So this is one of the things that when you look at data, it's not just the data that's important; it's what you can do with it as well. One of the things that a colleague of mine did recently was look at the performance of office buildings that are located within 0.2 miles of a railway station in London compared to properties that aren't. We all talk about it's supporting trends that we all know are happening. So everybody's talking about the importance of connectivity and the post-COVID idea that people don't want to get on a second mode of transport. They don't like the tube, want to get to their destination as quick as they can and get off. Everyone talks about this, but nobody had ever really presented any solid data behind it. And that's what I love about the way we do things at Costar, is that we're not property investors. We don't own anything. We don't benefit from talking the market up. We don't benefit from talking the market down.
Yeah.
The data that we present is just the data. So everything's on a building level, within those analytics. So the analytics aren't just assumed directions of travel for different indicators. They are aggregated data of building level information. And so, if our data says that, vacancy rates are going down for properties within 0.2 miles of a railway station and rents are going up, then that's what the data says. This is correct.
Yeah. And to dig into it, because that's an interesting point. So let's say that my office building was within 0.2 miles of a railway station, but that railway station happened to be one that you would have to catch typically a second train to. So maybe you catch the Elizabeth line in somewhere and then you have to catch another tube station. Are you sort of saying that those tube stations that can be defined as being a second stop for most people are not as attractive as those that are kind of a primary stop? Is that...
these were mainline stations.
All mainline,
so
okay.
not Elizabeth line stations.
Okay.
But yeah, we didn't. So the thing is, it's very hard in London to look at performance within a certain radius of a tube station, because there are so many tube stations that I remember looking at before the Elizabeth line came into operation. We sort of looked at a half a mile or a mile radius around Liverpool Street Station. It's virtually the entire city, apart from like a very thin sliver of land along the north side of the river. So you can't really get anything meaningful from saying, demand will increase for properties within a mile radius of Crossrail, because in London you're never really more than 5 or 10 minutes walk from a tube station anyway. So it was more those historic locations like King's Cross, Paddington, maybe London Bridge, sort of Liverpool Street and beyond, that has historically been trading at a discount to properties in something like Mayfair or the Bank of England around there. They're still cheaper, but the growth rate is much quicker. And so that's, if you're an investor, you've gone to your top-down approach like we were talking about earlier, and you can then go, right, I'd love to buy something in London. I've not bought in London before. I've bought once and I'm a second-time buyer, so I'm still quite low on that risk curve. Where should I buy? And you think, oh, wow, that's quite compelling. It's better than saying, rents in the West End are going up, but the city is staying the same. This is properly getting to micro locations. And the thing with Costar, you can do this with anything.
Yep.
You can say, I want to look at buildings with terraces. How have they performed versus buildings without them? And you can legitimately do that. I mean, it's making this off the top of my head now, but your limitation with the data is your imagination, really, which sounds like a strapline, but it's true.
Yeah, because it starts from such a granular starting point, and you can build it up from there. That's really interesting. So I think a lot of commercial property investment managers talk about being data. I often get confused about people from New Zealand where they say data or data. I think it's data here. So I'm going to say data-driven investment is a common term that's used. Now, I appreciate you haven't worked as much on the buy side, but how have you seen investment managers who claim to be data-driven really put that into practice?
It's an interesting one. There's a spectrum, really, and so I think it would be wrong to talk about one particular approach, but to give you two extremes. During my time on the brokerage side, we would get some investment managers come along and saying, right, I want to buy this building, and I need you to give me the data to support that. And right, okay, that's an interesting approach.
I've definitely seen that before.
Yeah, so off you'd go and you'd have a look through the data, and you might perhaps not major so heavily on the negatives, and you'd send through the positive data and say, look, this is enough data for you to take to your investment committee and probably get the sign-off. in reality, we would probably never have done that if we genuinely thought it was a bad idea. But there are situations where, experience, skill as an investment manager, you know what's going to probably be a good buy. But, it would be a real shame to lose that because you couldn't find the data to back it up. South Bank is a great example. The other extreme would be, we had one of the biggest property owners in the world come to us and say, we want to buy this asset. Can you send us details of every investment transaction in London for the last 20 years? It's like,
Wow.
why do you want that? And he's like, no, we need it. And we had this sort of backwards and forwards, and we ended up sending them everything. And they came back and said, but this is just transaction level data. We want the tenants and the WALTs for every building. And we said, well, we don't have it.
Yeah,
it's like, enough's enough. Like, nobody has that information sort of sitting there, which actually is another really important point with the data. So going slightly off topic here, but there is an understanding, or there's a misconception that somewhere out there in the ether is the source of all data. So there's a lot of people I've worked with, not on the research or analytics side, who just think that it's a case of tapping into this magical source.
Right, it exists somewhere out there,
somewhere.
And somebody's putting it together, or it's being pulled together somehow, and you just need to sort of dip your straw into it and then take it out. Okay.
And it's logical, right? You think that the government must have this information somewhere. Surely, how can you have this entire investment class that isn't being tracked formally by somebody with a bit of responsibility, but it isn't there. It exists in the archives of the landlords, the brokers, the valuers, that kind of thing, but it all exists independently. So one of the struggles that we have as a data analyst is trying to produce quality analytics within the framework of naturally limited data, because it can't get beyond a certain level. So, I've been asked in the past to provide, lists of everybody who's going to be moving offices in the next 5 years. I mean, it's...
Where do you start?
Exactly.
Yeah.
I mean, you can have a look at, all the lease expiries you have over the next 5 years and make assumptions from that, but you don't take into account expansions, consolidations, mergers, just general obsolescence, downsizing. There's things that nobody knows. The company probably doesn't even know yet that it's going to move within 5 years, especially if it's a smaller company. But these are things that are expected of real estate data analysts to have the answers to. And so, I think a lot of what we try and do as analysts is education. And by saying to people, you are a brilliant development manager or a brilliant broker or a valuer.
Yep.
You are at top of your tree. You are excellent at that. And you think you know all about data, but you don't. And it's like, in the same way you would leave marketing to the marketing team, you would leave, accounting to the accounts team, leave the data analytics
Specialist
to
team.
to the guys who've been doing it for a long time. Because, we know exactly what the limitations are, but we also know where the opportunities are too. So if you try and sort of ring fence, or if you've already decided what you think you want out of the data, you're probably going to get less out of it than you do by having a bit of a looser approach. So, for example, we talked about the top down. If you were to go and say, I want to basically only select properties that are asset management opportunities in areas of London that have seen rental growth for second-hand properties. Then you can narrow it down to maybe 500 properties and then start looking at each individual one of those to see which one fits your investment criteria. If you're just looking at a bigger market and saying, right, I want something that's going to make me money, you're going to miss a lot of opportunities there, or you're just going to spend an inordinate amount of time sort of drilling down into those
It's too large,
buildings.
right?
Yeah.
I think I'd like to wrap this podcast up with a question for you, Patrick. And it sort of links back to the first question I asked about property being opaque. And okay, so we accept it's opaque. What is the best strategy, and you have to pick one, and you have to defend the other one.
Okay.
So you could be a purely relationship-driven person who wants to know everybody in the market and attend all of the networking events, probably be in the pub quite a lot, speaking to agents and brokers and so on. And your strategy is to be completely relationship-driven to find out what's going on. Or you can be completely data-driven, and your approach is that you just want to collect data from every possible source and analyze it. Who are you backing as an investment manager, and why? Or is it possible to do one without the other?
Okay. If you put a gun to my head, I'm going to say data every time. And the reason I say that is because there is an inherent bias in the information you will get from relationships.
Mm-hmm.
So you are likely to be in that pub, be in that wine bar with somebody who graduated in the same year as you did, perhaps, maybe shares your sporting interests, maybe comes from a similar background. And they will inevitably be working on similar things to you. So say, for example, you're a London office agent, right?
Mm.
You are maybe, you're fairly senior. You're probably in your 50s. You're a guy. And you and all of your contemporaries are going to be working on big, shiny, prime deals.
So you're in a bit of an echo chamber.
Absolutely. Well, there is that, but also all the information you'll be getting is going to be on prime, big, shiny deals, which is a completely different market to 10-year-old, mid-size, still fairly good quality assets that probably make up 95% of the market. So your view of the market isn't a view of the market. Your view of the market is a view of the prime, big, shiny, large market. So if somebody comes along to you and says, we're diversifying out of prime offices, we want to go and see which areas of London are up and coming, and we want to get asset management opportunities for something with 3 or 4 years left on the lease, or, you don't know anything about that market. You haven't got a clue. So how do you identify what's a bargain or not? It's not going to be that difficult, but it's a hypothetical sort of scenario. Whereas with the data, you could look at it in a very dispassionate way, and you would be able to know all of these things about everything. Now, in reality, the big shiny stuff, a lot of that is pre-let, so the rental data and the terms are never released. So a third-party provider like Costar often doesn't get them because they're never publicly available. So you need your relationships for that. The reality as well, for any agent, you're always going to be operating in one particular sort of band of the market more than another.
Sure.
So you need those relationships to go and talk to people and try and bring in as much as you can. But I think it would be a lot easier to start with the data and then maybe tap into a couple of relationships if you had to, than start with the relationships, then try and scurry around getting the data afterwards.
Yep. I would agree with you, Patrick. I would put the data-driven approach first, and then look for relationships in the specific area that you need to find that specific information about. That was really interesting. I really enjoy analytics, and I can tell you obviously you do as well. So I particularly enjoyed that chat, and just want to say thank you for joining us.
Thanks, Sam. I really appreciate the opportunity.